Is Warner Bros. Discovery undervalued today? It has recently had an almost 20% run up in its stock price after being beaten up quite badly in the prior period. The stock has a $21 billion market cap and is the result of the Time Warner Media spinoff from AT&T being merged together with Discovery. This means that not only do they have everything from the Time Warner side of things, but they also have all of the reality TV and stuff you expect from Discovery, and TLC is another brand that's owned under there, and they have the Max streaming platform. So this is a pretty big media conglomerate. They have iconic stuff like Game of Thrones, classics like The Sopranos that are groundbreaking TV from back in the day. Of course, more recently, they've got House of the Dragon and all that stuff. So this is definitely a force to be reckoned with in this space. I don't think they're profitable yet on the streaming, but I think eventually these companies will get that sorted out and figured out. So what is going on with Warner Bros. Discovery and its valuation? You can see that since the merger, the revenue has been more or less flat. There's been a few peaks and valleys. Probably one of these peaks when they've had maybe some major blockbuster movies come out, and maybe some of the dips sort of in the slow times when there's not new ticket sales or new subscriptions coming in for something that's anticipated on the Max streaming platform. They probably also have some legacy TV advertising business that's shrinking, while at the same time Max is growing, and that's probably more or less balancing this out. But I don't think that you're going to see massive top-line revenue growth from this. You may see some peaks if they release a blockbuster film, but you're not going to see a 45-degree angle right and upward, I don't think, on this one. The big draw, in my view, with this name, since the merger especially, has been they've had a few quarters where they've posted up just phenomenal amounts of free cash flow. Over $3 billion, actually, in Q4 of 2023. That is a massive amount for a company with a market cap of around $21 billion to do in a single quarter. And the free cash flow has been sort of the thing that value investors are looking at on this one, because their net income has surprisingly been negative since the merger. And there could be a lot of different reasons for that. A lot of things can be counted against net income on paper with GAAP accounting. So the cash flow is what I think tells the tale on this, or at least that's what it seems like investors are thinking. In spite of the sort of standout quarters that they've had in free cash flow, and some of them have not been so impressive, by the way, but they have had some really good ones that sort of balance it out and make it seem like this thing can produce a lot of free cash flow. The concern, though, is the debt, okay? Unlike Robert Kiyosaki, most investors don't like to see a lot of debt, especially when it's in the tens of billions of dollars. And this is close to double their market cap and debt that they currently have. However, as you can see, that since the merger, it has been steadily declining. It went up massively because when AT&T spun off Time Warner, they sent about $40 billion in debt with it, meaning that then got added on top to the new combined company, Warner Bros. Discovery. And they've been chipping away at it steadily, quarter by quarter, since the merger happened. And it was over $50 billion total in debt, and it's now under $40 billion. So they are doing a pretty good job chipping away at this, but they are still highly levered, and I think this does worry some investors. There is a risk that if there is a sustained disruption in cash flow, that making the interest payment on this could get difficult pretty quickly. And that might force them to do something like massively dilute or something else that's not really good for shareholder value. But circling back to valuation, we have a price to free cash flow that is low single digits in regards to the trailing 12 months. This is extremely low. And I think that the reason that it has gotten this low is simply because of the risk that people see in that balance sheet. That debt level is still at a pretty scary level for a lot of investors. So a lot of people will simply avoid companies that are highly levered because they rightly view that high level of debt in this, especially in this slightly higher interest rate environment we have now. They view that as a risk, and they just don't want to put their money on the line in the face of such a large wall of debt. And their maturities are coming due. They have a lot in the next handful of years, and they've really got to navigate that wisely in order to persist. And I think it's more likely than not that they do, but still, I understand why some people would be concerned and avoid the name. Analysts tend to agree that this is probably a buy at today's price, with the low 12-month of $7 and a high of $20. The average falls in low double digits at just over $12 a share, and it could be worth about that. It's certainly, I think the free cash flow does justify a higher valuation than what we have today, but I think you do have to also factor in the debt, maybe make some adjustments for that, and give yourself some kind of a margin of safety. So if they do manage to navigate that debt and do good things to return value to shareholders with that cash flow, that you at least end up with an above average return on the flip side of all of that. Personally, when I run the scenarios in a DCF calculator, I think we want to start with the trailing 12 months free cash flow and say, hey, this is hopefully sustainable, maybe keeping up with inflation. That's not really growing, though, substantially beyond that. We want to potentially use a higher than 10% discount rate. I have the 10% in here just to kind of see like what the quote unquote intrinsic value might be. But you might say, hey, like I need more juice, give me a 12% or something like that. And that's perfectly viable. I did discount them for their tangible book value completely, which I think is actually beating them up maybe even a little more than is necessary, because that sort of discounts their ability to maybe sell off certain brands or franchises, individual channels. Warner Brothers and Discovery own all kinds of IP, and I think selling certain things off, they could probably realize some of their value on their balance sheet that's not strictly in the tangible book value section. But that's neither here nor there. I think it's okay to be conservative here. Funny enough, if you did run this same exact model with a 12% discount rate, you get almost exactly today's stock price, which tells me that perhaps analysts and the market themselves, analysts are saying on average maybe it's worth about $12 or $13, if you remember from the targets we looked at before. But the market is saying, hey, because of the risk on this debt, we're going to discount it a little bit more from that and wait and see how they deal with it. So I kind of understand why the market's pricing it the way it is. I took a small chance. I have a couple hundred shares, nothing major. And so far, like I'm up a little bit. I'm doing okay. So we'll see how things go, though, with Warner Brothers Discovery. It's certainly an interesting name, arguably a cigar butt in this space compared to something like Netflix. But hey, sometimes the cigar butts have one last puff. If you have Warner Brothers Discovery, make sure you comment on the video and let me know what you think of its value. As always, like for the algorithm, subscribe to the channel to never miss another video. Follow me on Twitter or X, if you want to call it that, at Mr. Macho Mog. Link in the description. That is the important one. I'm really trying to build out my following there. Make sure that you join Discord, link in the description, and catch me every Saturday, 8 p.m. Eastern, Cash Flow Kings Live, link in the description. Also, if you want to support me directly, consider being a member. I try to focus on pleasing my members all the time. Take it easy.